Now, during the year, we took the opportunity to promote Josh to a broader role with the group. While still remaining very closely involved with the credit business, Josh will also be helping to bring all of our investor communications, our relations with investors into the 21st century. He's going to work closely with the growth fund and credit fund teams to streamline the way that our funds interact with you, our partners, and also, of course, our SPV business. Andrew has been promoted to head of credit, and I wanted to ask both Josh and Andrew to to come up and talk about credit.
Great. Thanks very much, Barry. Well, 22% returns are a hard act to follow, and indeed the credit fund has not achieved returns in that vicinity for the last financial year. But in truth, what the credit fund's done is exactly what we always intended it to do, which is to achieve low volatility, income-generating returns, which provide a complement to equities in the context of a diversified portfolio. In the last financial year, you can see here we've achieved 4.38% return for the credit fund. That gives us 10.58% return, annualised, going back to inception over 5 years ago now, in February 2010. Both those returns are after management fees but before performance fees. The credit fund has also generated a distribution of 8.29 cents in the last financial year, giving a distribution yield for the last year of 6.85%. Now, as many of you would have heard us say at recent AGMs and our newsletters, we often talked about the sort of returns, the double-digit returns, that the credit fund had been achieving in previous years, not being sustainable on a long-term basis. And indeed, what had really happened is that the returns the credit fund had been achieving were being brought forward from future years. Such that for investors who have been in the fund for a number of years now, they're still achieving returns at above our target return being RBA cash rate plus 3 to 5%. With cash at 2% today, that gives us a range that we're currently targeting of 5 to 7% returns, which investors in the fund for the last few years have performed at or above. And equally as importantly, looking forward, as we look at the new opportunities in front of us now and the type of investments we're making today, and Andrew's going to come up and talk more about those shortly, we feel very confident that investors who are entering the fund today will also, over the next 3 to 5 years, achieve a return in line with our target of RBA cash rate plus 3 to 5%. I'd like to invite Andrew to the stage now to talk a little bit more about those opportunities and also the outlook for the credit fund.
Just wanted to start off by just clarifying, with cash rates at 2%, we target really looking for opportunities that are at least in the 5 to 7% range. And when we say returns and credit fund and yields to maturity, we do complicate things, but really we're just making a loan to either a bank or a corporate on a period of 5 to 7 years and looking to generate interest over that period. The fund currently yields 4.8% post fees, but as we deploy cash into the opportunities, that will obviously rise. We are very conscious of volatility, and certainly we're being patient in deploying that cash. The fund is a floating rate fund, and we don't expect interest rates to rise anytime soon. In fact, we think it'll be some time. But when they eventually do and normalise, the fund will benefit from that normalisation. We're still seeing good opportunities. We have similar views to the growth fund in terms of some of the challenges that the markets face and corporate profits and growth. And we're in a low interest rate environment, and we expect those challenges to continue for some time. But you can see up there we've made 4 investments over the last quarter, all generating sort of 8% type returns. We continue to look for companies that can generate stable cash flows right through the cycle in adverse conditions. The other thing I just wanted to mention, and Barry touched on the SPVs, this was transactions that really came out of investments that were either too large or weren't within the risk profile or the mandate of the credit fund. But they're investments we wanted to make with our own money, as we do with all of our investments at Riverine Funds. And so we worked on a strategy to bring in co-investors into those individual transactions. We've done 5 to date, totaling 76 million. The returns tend to be higher than the credit fund, really recognising the higher risk profile. But we're still comfortable in making those investments. They tend to be sort of the 10 to 15% returning opportunities. We've still got 4 outstanding and all are performing well. So we anticipate further opportunities, both credit and equity, leveraging off the networks and expertise we've developed along the journey. As Barry sort of touched on, I also just wanted to thank the broader credit team. It hasn't just been Josh and I through the journey. Dinesh, Emma and John and Alistair have made a huge contribution this year. I think part of the difference with credit and equities, a lot of ours is buying securities in international markets, and it does require commitment after hours. So it's a huge team effort, much appreciated.
Some questions for the credit fund guys on credit or SPVs. Someone's giving me signs up the back. Any questions for Andrew, Josh, or indeed any of the guys here? Up the back, I can't see. That's Laurie. Hi, Laurie.
You quote your returns after management fees, but before performance fees. Performance fees are a cost to the investor, so why don't you quote your returns after both?
Yeah, thanks, Laurie. It's a good question. We haven't done it because we believe we charge performance fees differently to the way other funds do. Most funds have performance fees charged as an expense of the fund, whereas we from the outset have always charged performance fees to an individual investor based on their account. And whilst it takes a lot of time because we do that individually for every investor, it also gives us flexibility, to ensure that there's nothing unreasonable or unfair that comes from perhaps investing in a fund and having a performance fee charged when perhaps you haven't received the performance. So the answer is that every one of our investors has a different starting point and measurement point, and therefore we will have a different fee structure and a different return. So we therefore don't quote the fund returns after performance fees because the performance fee isn't charged to the fund. I think we do actually in the annual letter though, we do actually make reference. I'm pretty conscious of that fact, and in the annual letter, in a footnote to the table, we actually calculate what that return is had an investor paid a performance fee every year on the way through. So it's clearly, for an investor that has been through the journey and paid a 15% performance fee on that return, it's going to be about 15% less than on a per annum basis. So if the return is 20, then the investor would be at 17 net of performance fee. But the reason we don't do it is because we do charge the fee and invoice the fee separately to every investor. Jeff.
I noticed that RMBS on that list of credit investments. Are there many in the fund? And the second point.
Jeff, there's currently 10% of the fund in RMBS, and we do see RMBS really is a pure mortgage product. Banks on top of the 10%, we have another 17% invested in Australian banks. So across the portfolio, the mortgage exposure is no greater than 30%. So we certainly recognise where we are in the cycle in terms of the mortgage market. We don't expect interest rates to rise dramatically in the near term, and so I think the environment for property continues to be supported through that low rate environment. But at some stage that'll normalise, and we can see every day in the press, whether it be the RBA or APRA, really trying to talk down the property market, because I think with rates so low, the pressure is that it continues to go further into bubble territory.
Jack, sorry, Elliot, I'm not picking on you.
Can you tell us what the size of the credit fund is now?
Yeah, absolutely.
Yeah, so credit fund is 130 million total fund, and it now has over 130 investors.
And we quote a number higher than that, Jack, because unlike the equities business, the credit business has individually managed accounts that effectively replicate the investments in the credit fund. So the total assets, if you like, deployed in the credit strategy are about 350 million, separate to the equity strategy, but it's made up of a pooled fund. In the case of the credit fund, it's made up of the individually managed accounts for investors that have more sizable investments, and it's made up of the SPVs. Elliot.
Andrew or Josh, can you please explain negative interest rates?
Thanks. It's some of it's a currency play. So some of it's investors. If you look at the Swiss franc, for example, I guess you're talking about like the Swiss franc particularly is a currency of note, and there are a lot of the countries in Europe in the short term have negative interest rates, and if Switzerland in particular, so people wanting to take advantage and speculate that the Swiss franc will appreciate will invest in Swiss francs, and when you buy Swiss francs, you've got to deposit it at the bank or in a government bond or something of the like. So you take a small negative interest rate in the hope that you make a currency gain, appreciation. That's part of it. Another part of it is at different times it can be concern about the banking system, perhaps. Can be a concern about, I know certainly with the with German bunds, for example, a lot of it was a play on the breakup of the euro, with again currency speculation that the Deutschmark, if it broke apart and you bought euro German bunds denominated in euros, and you got Deutschmarks back, those Deutschmarks would appreciate and be a lot stronger than is implied by the weighting that they have in the euro basket. So I hope that answers part of the question.
Well, I think, Josh, I might hand over to you if there are no further questions on credit. I might hand over to you to make a few remarks and to turn over to Susie for some concluding comments.
Thanks. As Barry mentioned earlier, I was recently honoured to be offered a new role and taken on a new role here at River Capital, being Director of Group Investor Relations. And it's a new role not only for me, but also for River Capital. And it's a new role that makes an important statement. Makes a statement here at River Capital, not only do we highly value our investments and our analysis, but that we also highly value our relationships with each of you. And to us, River Capital is much more than just a place that makes great investments. To us, River Capital is an opportunity to lead by example. It's an opportunity to act with integrity in the world of finance. River Capital is a place where we value our clients' investments in more than just dollar terms. We seek to respect and value the hard work and sacrifice that you made and your families made in generating the wealth which you've now entrusted to us to manage on your behalf. And River Capital is an opportunity for us to redefine what it means to be an asset manager. So on a forward-looking basis, I'm really looking forward to being your primary point of contact here at River Capital. And I'd also like to take the chance to thank Paul Cowan, who fulfilled the role so well for the last 12 or 13 years and has been a great friend and teacher to me as well. So I very much look forward to spending time with each of you over the coming months and years, getting a chance to sit down and to chat. And we'd like it to be a two-way street. We'd like to have an open dialogue with you. We want to learn from you as well. Because I know this sounds a little bit corny or cheesy, but I do believe it to be true. Business is not a transaction, it is a relationship. So thank you very much for all coming here tonight again. I'd like to welcome Susie Karp, co-founder of River Capital, to come to the stage with some closing remarks.
So I'm here to give thanks and gratitude as a co-founder, shareholder, director, investor, and most importantly, a wife. I have a confession that in our business, and maybe it's also our mindset, we are very high achievers. It's often very difficult to take a moment to pause and reflect on our successes and what we have achieved and created here at River. The space we're in is really tricky. When success is measured by numbers, percentage returns, moments in time, overreaction, lack of perspective, are often the most dominant forces in our day. So today, I want you all, guys and girls, to pause and would like to publicly thank and recognise you and congratulate the team at River. It's been an outstanding effort and one that we all should be really proud of. And I want you to know it's a team effort with a group of very talented, committed, disciplined and wise heads. Starting with our board, which is led by our executive chair, Jim. Seriously, Jim, I don't know what we would do without you. And with you by our side, Barry and I know we're doing something right. Jim not only chairs our board, but he also sits on our investment committees for the Credit Fund and Growth Fund, and is an unwavering support to Barry and I, helping us navigate our way. That's the next movie. Helping us navigate our way and managing the growth with such integrity and purpose. Thank you. To David, thank you for agreeing to share your story with us tonight, but more importantly for your unconditional support, wisdom, clarity, humility and independence. We are very grateful to have you on our journey. And also to our third independent director, Tony Robinson, who I think is the smartest one. He's currently enjoying the successful year in the south of France. So much goes on behind the scenes at River that you don't see. A special mention to Paul, and Paul's not going anywhere. We wouldn't let him go anywhere. To Tom, John, Emma, Wendy, Di, Agatha, and the lovely Emma. Thank you for everything. But really, as Josh mentioned, success is more than just financial returns for us. It just has to be. Of course, it's our priority and commitment to you, but Barry and I strive to create a work environment that supports and nurtures individuals to be the best that they can be. The balance, as I already mentioned, is really challenging at times, but worthwhile, and we're acutely aware and mindful of the need for perspective, humility, gratitude in all that we do. Having a smiling mind in our office and our work in our community is always a great reminder, and I forgot to do that. So on that note, I'd like to conclude by thanking you all, our investors and friends, for your ongoing support and trust. It's been a wonderful journey over the past 20 years for Barry and I, one that we're really grateful for, and we really appreciate the enormous responsibility bestowed on us by you. I recently read somewhere that at the end of the day, you have to look back and ask yourself, how good was the journey and was it worthwhile? Well, from us to you, it's been an unbelievable journey and so very worthwhile. Thank you.